Things. One of the points I've been trying to make on the show recently is that security selection is not going to be the answer to how much pain you're going to take in a moment like this. And that was proven this week. The XLU, which is the utility sector, which normally in any market correction is not going to be disastrous, was absolutely disastrous. I'm not even giving you the drawdown from the peak. I'm just going to tell you this week, the XLU is down 19%. So I think that that's indicative of what we've seen across the board. There really has been nothing safe. And yesterday, of course, historic day, at 3:30, there wasn't a single green S&P 500 stock. So security selection has not mattered. And I come back to this idea that only diversification, owning both stocks and bonds, and only portfolio construction is going to be the answer. The other thing I want to tell you is what I told my clients last night in a letter, which since we founded the firm, I've only written one 3 times. And what I basically said was that without a doubt, we know the headlines are going to get worse. They're not going to be better. Like this weekend, they'll be really bad, and no one will be able to access their investments and move things around. And they'll be worse when we start testing more, which hopefully happens. You want to see higher totals. I hate saying this because then you know that we're doing more tests. So if you know the headlines will get worse, what is the only question you need to ask? You need to ask, at what point does the market stop reacting every time a negative headline comes out? Only then will you know that we're getting closer to the end, and we are not there.
So, very good points. I want to read some of the commentary from the street today and get your reaction to it, to the point of how much downside is really left, Joe, in this market. Morgan Stanley's Mike Wilson weighs in on that question and says we're now trading slightly below our downside case on the S&P 500 and believe it is time to start adding to equity risk for long-term investors. Wells Fargo today says put new money to work. With the 16.5% week-to-date slide in the S&P, the risk-reward now appears more attractive. I follow that up with one more point, and that comes from Howard Marks today in a letter from clients near the end. Quote, all great investments begin in discomfort. One thing we know is that there is great discomfort today. So what do you do with that?
What you do with that is I think you begin to understand that this is going to be a process of which equities are going to be bottoming. With that, I think you begin to slowly buy into this market. You first ask yourself this question: can I endure another 15 to 20% lower for the equities market? If you can, you then ask yourself, will I get that back? And I believe, excuse me, I believe the answer to that unequivocally is you will. Communication response from fiscal policymakers, from global central banks, and from healthcare officials. So if you can endure the potential for more downside, yes, absolutely. I believe you want to buy because you're going to get it back.
All right. So, Jenny, Barclays asks, are we there yet? Are we near a bottom?
I think we've got to be pretty close. And I think that because I look at what S&P earnings started the year at, we trimmed them in-house. We trimmed them by 5% and kind of stress tested with different multiples. Goldman put out a note yesterday, a call, where they also said we expect at this point that earnings on the S&P will be down 5%. And so if you take that earnings where they started the year, cut it by 5%, put a multiple on it where we bottomed in 2018 at 14.5 times, cut a little off of that, we're pretty near a bottom in the 2,400 range on the S&P 500.
Okay, so J.P. Morgan, though, says we're going to have a recession. In fact, we're having one, right? You're going to get -2 this quarter in growth, and you're going to get -3 next. So if that comes to fruition, does your calculus change?
Not necessarily. And this is where I go to Ed Yardeni, who's one of my favorite strategists, who says we may have a recession this quarter, next quarter, the quarter after, but then we could have serious rebound in the fourth quarter. And so if something like that plays out, the market, the market's going to anticipate 6 to 9 months in advance and could actually.
Even if you don't have a recession statistically, it's going to feel like one.
It's going to feel like one.
You're going to have one. And to Jenny's point, let me just say this very quickly. To Jenny's point, you are absolutely going to have industries that are already in recession and what feels like depression. That's no matter what the national data says across all regions and across all industries. So that is already in progress. It's not something that could happen. And everyone's expectations have to now factor that in. You cannot have the expectation that even if the stock market rebounds, the country's not going to be feeling it.
All right. So, Keith Banks, you've heard the commentary We're going to lean on you now for your years of expertise in these markets to tell us what you're thinking and what you think the average investor needs to think about and do today.
Well, look, Scott, I think the biggest challenge right now for investors is we're still dealing with what we call the known unknowns. We don't know, and I think Josh made some of this point, how much longer the coronavirus will be spreading, what the number of additional cases will be, what the death rate will be. That's number one. Until we'd have a better feel for that, we don't know what the impact on the global and U.S. economy will be. And until we know that, we're not going to know really where the earnings picture comes to pass. So I think we have to get more insight. We are in a bear market now, by technically speaking. And so I think it takes 3 or 4 months typically for a bear market to find a bottom. So I think we're getting closer, but I think there's still some time to come. And we're going to have a prey to some bad news. The point was made, right? There are going to be more cases once the kits are available. I think companies have to still come out and adjust earnings downwards. And I think economic activity will still be adjusted downwards also. So we're probably a bit early. But, I would also say you got to remember, if you go from the 30s on, if you had missed the 10 best performing days in each decade, your return over that period would have been 91%. Had you stayed in, your return would have been 15,000%. So trying to zig and zag in and out of the markets doesn't work. So I wouldn't be selling here. I might be holding off a bit to put more money in, but you don't want to be trying to do the day trade game.